Tax legislation provides a simplified capital allowance system for small business entities. The system is optional to enter and has two main methods of claiming deductions: the pooling method or the immediate write-off for low-cost assets. The first thing we need to consider is whether the taxpayer is a small business entity or SBE. A taxpayer will be an SBE if it carried on a business that year and satisfied the aggregate turnover test. Other areas that need to be considered include what the taxable use percentage is for relevant assets, whether the taxpayer has existing assets that have previously been depreciated, whether new assets are at or below the threshold for immediate write-off, and the rates of decline that are permitted for assets both entering the pool and for future periods. Small Proprietary Limited carries on a business and has a low aggregate turnover. Small Proprietary Limited elected to use the SBE Capital Allowance system during the income year just ended. The asset register items are used 60% for earning assessable income and 40% for exempt income. Upon entering the SBE Capital Allowance system with existing assets, Small Proprietary Limited quarantines its existing low-value pool and software development pool. Assets in the low-value pool are not allocated to the SBE pool, and the decline in value is calculated as per normal for a low-value pool. That is, the rate for subsequent periods based on the asset's opening adjustable value. All of Small Proprietary Limited's existing depreciating assets that were installed in the previous year and not in an existing pool are now allocated to the SBE pool. So the taxable use percentage of the machinery opening adjustable value is allocated to the SBE pool opening balance, and the decline rate for opening balances is applied. Now we consider the situation where Small Proprietary Limited purchased two assets during the year. Asset 1 had a cost of at least the threshold for immediate write-off, and therefore 60% of its costs will be allocated to the SBE pool. Asset 1 receives a decline rate that applies to newly added non-low-cost assets this year. Asset 2 is a low-cost asset as it costs less than the threshold for immediate write-off. Therefore, it is not allocated to the SBE pool. Small Proprietary Limited is allowed an immediate deduction for the taxable use percentage of this asset. Where a low-cost asset is not initially pooled and its adjustable value is zero after the cost is deducted, we need to be aware of the tax treatment for future year enhancements. That is, if in a subsequent year, an amount less than the immediate write-off threshold is included in the second element of cost of that asset, then an immediate deduction is allowed for the taxable use percentage of that cost. Note that this is only for the first occurrence in the year after installation. So if Small Proprietary Limited was to make a cost addition under the immediate write-off threshold to Asset 2 in a later income year, then an immediate deduction representing the 60% taxable purpose is allowed. However, if instead a cost addition amount that is at least the immediate write-off threshold was made, then the asset is allocated to the SBE pool with an adjustable value representing its 60% taxable use. A decline rate for subsequent cost additions would be applied to this in the year that the asset is allocated to the pool. To work out the closing pool balance, we take the opening pool balance, add the taxable purpose percentage of allocated assets that year and cost additions to pooled assets. Deduct the taxable purpose percentage of the termination value for assets in the pool. Deduct the specified decline rate on the pool opening balance. Deduct the specified decline rate on allocated asset values this year. And finally, deduct the specified decline rate of any allocated cost additions this year. Note that if the termination value takes the closing balance below zero, then the surplus is included in assessable income. We now have to consider the pool closing balance. If the closing balance under a simplified calculation, ignoring decline, is less than the immediate write-off threshold, but greater than zero, then an immediate deduction is available for the balance, leaving a zero pool balance. This is instead of claiming deductions using the normal pooling methods. However, for the 2021 to 22 tax years, the closing balance can be deducted irrespective of its size. To recap, the key points to remember with the SBE Capital Allowance system are that it is optional for SBE taxpayers. The primary method used is pooling with various decline rates depending on the status of the asset. However, low-cost assets may be deducted immediately.